Hey everyone, Peter here. I wanted to shoot you a quick video because the S&P 500 was down 3.4%. So S&P 500 is the largest US stocks. It's one of the most commonly reported benchmarks for stock market performance. And this is one of the biggest down days we've had. It is the biggest down day we've had since February of 2018. And so I got a couple questions today and felt like maybe I could put some of this into context to give you a little insight into how you might react or might not react in response to some of this news. So the coronavirus, certainly there have been more infected cases and more deaths. The toll keeps rising than what a lot of people were expecting, and obviously than people were hoping. But we are now getting confirmation that in Italy and South Korea, they're seeing more of these cases. And so there's a little bit more concern than there was prior that this virus might be impacting global GDP or economic growth more so than we previously would have expected. Now, when it comes to stock market investing, we never know when or why a downturn is going to occur, but we can plan on them occurring with a similar level and frequency that they have in the past. And this type of market move, while it's not common in the everyday sense, it is actually quite common when you look over long periods of time to see markets readjust pricing expectations based on new information. Now, I would say, if you're looking for a defensive move, that was a question I got today. Are there any defensive moves we can make? Well, that's sort of a form of what we consider to be market timing. It's also similar to the question I got of, should we be going to cash with any part of our portfolio? And here's the thing, anytime you make a shift, you're actively saying that you know when to get out and when to get in. Now, sometimes selling assets results in taxes, and that can be unnecessary, but truly it's very difficult to know when to get back into the market. And oftentimes the biggest up days follow the biggest down days. So as much as possible, as a general rule of thumb, we always try to encourage people not to go to cash in response to market moves. Now, I think a longer term lesson here is that you might have been nervous about the market for entirely different reasons over the past year. But I highly doubt that something like the coronavirus was on your radar is something that might move the markets this much. Sure, in the past month or couple weeks, that might have come on your radar, but there were a lot of 2020 outlooks that came up from really big wirehouses in Wall Street and research firms. And really that wasn't the risk they were talking about. And certainly 12 months ago, I don't think there was anybody who was coming to me concerned about the outbreak of some sort of virus. And so the good long-term lesson here is that the things that are unexpected and not being talked about, those are often the ones that catch markets by surprise and cause these repricings. And so I'd encourage you to think about the next time you're nervous about the market, think about those reasons and how well known are those reasons? Are they reasons that are discussed in the paper or in the media or in the investment profession? Because if they are, chances are price has already considered those risks and put them into price and expectations of stock returns. Now, it's kind of a longer term message. If we think of what can we do today? Well, if you're feeling nervous about your portfolio, a better action than looking to your portfolio to make a change would be to go to your financial plan. Because a good financial plan, again, like I said earlier, will take into account the historical ups and downs of markets, the magnitude, the frequency, and bake those into the assumptions. And so I have a chart here that I really like. This is not an original from Peter Lazaroff. I don't know who to attribute it to, so whoever came up with this chart, thank you, and I'm sorry that I can't attribute it to you. But good financial planning, here we are today. We're trying to get here. And life is not a linear line. It doesn't just move like this. This would make financial planning and investing very easy. But in reality, here is life on the path to our end destination. And along the way, a financial advisor can help you make course corrections. And sometimes these are life events. Sometimes they're bad life events, disability, a death. Sometimes they're good life events, a new birth or a promotion. But volatility and market volatility is part of this because market returns do not move in a straight line. And so I think, again, if you look at your portfolio every day, regardless of what's going on today and otherwise, the market is down about 50% of the time. It's actually up a little bit more than 50% of the time historically. So every time you check your portfolio, you get a little bit of feedback, and the chances of you having some negative feedback are higher the more frequent you look. And oftentimes you feel a little nervous when the market is down and your portfolio is down. And this is very normal and it's totally okay. It's okay to feel this way. The thing is that you should have a plan in place that accounted for these things. And that plan, it's the assumptions that go into it that would tell you whether you're set up for success or not. So I would say if you're feeling worried about the market, again, instead of looking to your portfolio to make a change, maybe consider looking at the assumptions going in your plan to make sure that you're ultimately going to get to your end destination. If you'd like more resources specifically tailored to your needs, head over to smartmoneyquiz.com. It's a quick quiz I put together, 9 questions that when you answer the different questions, I provide you some resources on things that will be specific to your situation. Thanks so much for watching.